Thanks for joining us today. Coming to you live from Seoul, I'm Lee Ji-yoon. And before we get started, let's first take a quick look at today's highlights. A shift in sentiment, at least from Korean investors who are offloading stocks on the Shanghai-Hong Kong Stock Connect. The country's main telecom companies are rolling out new phone plans for their users. Why the change and who's benefiting? We have these stories and more coming right up. Fear of the Middle East respiratory syndrome, or MERS, is starting to affect Korea's tourism industry. We're seeing tourists from China canceling their trips to Korea after hearing the news that MERS has been spreading in the country. According to Korea Tourism Organization, around 2,500 tourists from mainland China and Taiwan have called off their visits to Korea as of June 1st. The country's second largest tour agency saw a 9% cancellation rate from Chinese visitors for this month. There are growing concerns that potential losses might snowball in the face of the MERS outbreak. Back in 2003, when the SARS virus hit Asia, Korea's airliners saw millions of dollars in losses, and the number of foreign tourists that year dropped by 11% on year. Up and up again, Korea's foreign exchange reserves climbed to a record high for a second consecutive month in May, standing at $371.5 billion. The Bank of Korea said Wednesday its reserves gained $1.6 billion on month on the back of profit made on its foreign currency assets, despite the dip from the weakening euro. The euro fell 1.3% against the greenback in May. As of the end of April, Korea had the sixth largest foreign reserves in the world after China, Japan, Saudi Arabia, Switzerland, and Taiwan. In the face of Korea's troublesome slumping exports, its products are piling up in storage. Statistics Korea says the manufacturing sector's inventory picture, an economic indicator, is at its worst in 6 years and 3 months. Adding 3 percentage points from March's figure, April's inventory over shipments ratio exceeded 126%, equal to the rate recorded in January of 2009 when Korea's real economy started seeing the effects of the world financial crisis. Factories have also been operating at their lowest rate of production capacity since May of 2009 at under 74%. Korea's leading telecom companies have rolled out a number of new phone plans to win over customers and cater to their needs. Now, so far, the response has been good, with tens of thousands hopping over to these new billing plans. Now, what changes have people seen from switching to these new plans? Our Lee Ji-young on this story for us this morning.
Korea's 3 largest mobile carriers, SK Telecom, KT, and LG U+, all launched similar smartphone payment plans last month that charged users based on their data usage while offering almost unlimited voice calling and text messaging services. Take KT, for example, the first to introduce this system. Its lowest price plan offers a minimal 300 megabytes in data, but unlimited mobile calls for roughly $30 a month. Back when it first provided limitless calls in 2004, before smartphones became popularized, the monthly payment stood at roughly $90, meaning the new plan could be as much as 70% cheaper than 10 years ago. But if you look more closely, this new data phone plan does not actually benefit everybody. Of roughly 20,000 people surveyed, 7 out of 10 people saw their phone bills drop, while 3 actually saw an increase. The change in mobile billing methods simply reflects the growing importance of data, not only for phone users, but mobile carriers as well. With the ever-expanding market of smartphone messaging apps, social media, and online streaming, for many, how many minutes you have on your phone has become less important than how much data is available. The shift also comes as telecom companies look for new ways to compete after the government launched a massive crackdown on excessive phone subsidies for new handsets. By putting out varied options for users who have different phone use preferences, carriers are looking to attract more customers.
For those who use a lot of data and make a lot of calls, the new price plan will be better. But if you use a lot of data but don't make many phone calls, even if you change your phone plan, you won't see much change.
Other new plans include rollover systems that allow users to carry over unused data and family plans that come with extra data allotments from members. Lee Ju-young, Business Daily.
Now, there was a great deal of excitement leading up to the launch of the Shanghai-Hong Kong Stock Connect at the end of last year. But for the first time since its launch, we're seeing a switch in Korean investors offloading more Chinese stocks than they're purchasing. And we have our Eunice Kim with more on this story. Hello, Eunice.
Hello, Ji-yoon. That's right. We're now more than 6 months into the launch of the Hong Kong Stock Connect, and with another trading link in the works out of the mainland, we take a look at how Koreans have reacted to the arrangement meant to open up China's stock market to the world. Since launching in November of last year, the Shanghai-Hong Kong Stock Connect, or Tung, has seen an estimated 30,000 Koreans place their money on the market. By adjoining the exchanges in mainland China and Hong Kong, it opened up Chinese stocks and domestic investors to the world, where before strict restrictions imposed quotas on investment flowing north and southbound. Korean investors have shown swelling interest, particularly as the exchanges have performed exceptionally well. China's largest stock index, the Shanghai Composite, more than doubled in the span of a year, leaping some 90% since Tung was opened. While the Hang Seng's upward swing may not be as steep, it still grew by 22% on year and 20% after the Stock Connect took off. Riding on the gains, Korean investors were net buyers in the Stock Connect in the first 5 months of Tung's existence. But as the trading link entered its 6th month, that trend switched, with sellers outdoing buyers by more than $11 million. Although the returns have so far been generally handsome, with Korean investors taking home profits as high as 127% on the top-performing shares in net buying, the general consensus is individual investors were simply cashing in on what they perceived as a short-term surge. There are also opinions that it was driven by rising concerns of an overheated market, as experts caution against hasty investment. Experts also point to Korean regulations on overseas investing that tax stock profits of more than 20 million won, that's roughly $18,000, noting gains can be significantly less than what's made on the markets.
So Eunice, let's go back a little bit for those of us who are not so familiar with all this. Tell us a little bit more about the Shanghai-Hong Kong Stock Connect and how does it really compare in size to its other regional counterparts?
Well, in fact, June, if you combine the market cap of the two major stock indexes out of the mainland and Hong Kong, it does become the world's second largest exchange, second only to the New York Stock Exchange. Let's go ahead and take a closer look with a graph. Simply for comparison's sake, we went ahead and stacked the total listed market cap of Shanghai, Hong Kong, and the tech-heavy Shenzhen to show you that it holds its own, at least in face value, against the New York Stock Exchange. April figures from the World Federation of Exchanges also show that the Shanghai Bourse grew by 138% on year, which is a phenomenal growth.
Wow, that's quite the bull run. But of course, as you mentioned earlier in your report, we're seeing a shift in sentiment among Korean investors.
Right.
And of course, China is still quite a tricky experience for foreign investors in general.
Right, and stock changes hands very quickly on the Chinese market compared to some of its major counterparts around the world. And some of the more obscure movements within the markets, as well as the financial sector in general, certainly contribute to those wild swings. In fact, late last week, the Shanghai Composite took investors by surprise when it recorded its biggest drop since January, falling falling 6.5% following a 7-day rally. It was attributed to everything from brokerage firms tightening their margin requirements to investor jitters triggered by a, quote, unusual draining of funds from the banking system. And this amid growing voices warning of trouble ahead, characterizing Chinese stocks as overvalued and the Shanghai Composite as a bubble ready to burst, particularly as China's pace of growth has been slowing, and investors are watching very closely whether the government will be able to hit that growth target of somewhere in the span of 7%, even if it is the lowest that is set in 11 years.
And we'll have to see how all of this will play out on another trade link, the Shanghai-Hong Kong Stock Connect, which is still in the works, right?
And rumor has it, it'll open sometime later this year.
All right. Thank you, Eunice, for coming in today.
My pleasure.
All right, that'll do it for me for now. Hope you enjoyed it. We'll be back tomorrow with more, so please do check back with us then. Thanks for watching, and bye-bye for now.